Hi CS students, let's revise CA final AFM. Chapter 3 Advanced Capital Budgeting Decision. Practical question 23. A company has an old machine having book value 0 which can be sold for 50,000. The company is thinking to choose one from the two alternatives. First alternative is to incur additional cost of 10 lakh to upgrade the existing machinery, like repairing it and then upgrading it. Then the second one is to replace old machine with a new machine costing 20 lakhs plus installation cost. So in the second approach, the old machinery will be sold and a new machinery will be purchased. When the old machinery is getting sold, then tax implication will be there, and they have given a tax rate of 40%. Since they have given old machinery's book value is 0, so whatever it is sold for will attract tax. In our case, 50,000 will have a tax impact. Now both above proposals envisage useful life to be 5 years with salvage value to be nil. In both approaches, useful life will be 5 years, they are telling. So even in the new machinery also will work for 5 years. If we upgrade the old machinery, that also will work only for 5 years, having a salvage value as nil. The expected after tax profits. So they've given after tax profits for the above three alternatives. Okay, they've given first one is existing machineries after tax profits, then upgraded machinery once we incur the 10 lakh, then new machinery once we sell the old machinery and buy the new machinery, that one. So since we are comparing the decisions of upgrading or replacing, we have to take the incremental approach. What will be the incremental cost in each of the alternatives? The company follows straight line method of depreciation. Assume cost of capital to be 15%, and they have given present value factors, so we have to consider this only. You are required to advise the company as to which alternative is to be adopted. Going to the solution, first we have to figure out the incremental cash outflow. In the first scenario, since they have directly given 10 lakh, so 10 lakh will be the additional cost, which will be the initial cash outflow. In the second scenario, the old machinery is getting replaced. So replaced in the sense old machinery will be sold, new machinery will be purchased. So new machinery's cost of 20 lakh plus 50,000 installation cost will be total cost, less sale of old machinery which is sold for 50,000, which will be a cash inflow. Then we have to pay tax on that 40%, which we have to reduce, which is coming up to 20,000. Here they have given net of 50,000 minus 20,000, 30,000. That is also fine. If in case they have given any book value or something, then we have to reduce the book value from this sale value. Then to that extent we have to reduce the tax portion. Then going further, in previous questions we have seen cases of loss wherein we have a tax savings also. So going further, we have to calculate depreciation, because these are expected after tax profits, so wherein this includes depreciation, so we have to add back depreciation to this amount. If they have given revenue and cost, then we will take only tax benefit on depreciation, but here we have to add back the complete depreciation, as these are after tax profits, earnings after tax. So depreciation for the upgradation will be 10 lakh divided by 5 years, 2 lakhs. In case of new machinery, 20 plus 50,000, 20 lakh 50,000 divided by 5, 4 lakh 10,000. And since the old machinery's book value is 0, so depreciation will not impact. Or else, if the old machinery, as we have previously seen, if the old machinery has a book value, to that extent we should we should calculate a depreciation, and that portion has to be adjusted in this earnings after tax, and the resultant value has to be compared with the upgradation or replacement of new machinery, that will be considered as incremental cash flow after tax. But here, since the old machinery's book value is 0, we need not consider any depreciation. So whatever profit earnings after tax which they have given for old machinery, that can be compared with the upgradations after depreciation adjusted amounts, and then we can find out the incremental cost in both the cases. Here, as we can see, old machinery's cost is 5 lakh, 540, 580, 620 and 630. And in case of upgradation, wherein we have a after a tax profits of 550, 590, 610 and 650 and 700, and depreciation we know that it is 2 lakh. So when we add that to the existing values, we will get cash flow after tax. So the incremental cash flow after tax is, in case of first year, 7,50,000 minus this 5 lakh. So incremental is 2,50,000. And then for second year it is again 2,50,000. Then third year it is 2,30,000 and 2,40,000. Now these cash flows are the incremental cash flows. This has to be adjusted with the discount rates. Present value factors are already given, so we have to use that. Then same goes with replacement decision, wherein we have the existing machineries profit after tax. Now depreciation we have to add back in case of new machinery, and then the cash flow after tax will be reduced with the old machineries earnings after tax, and we will arrive at the incremental cash flow after tax for 5 years. Now whatever we got as the incremental cash flows, that we have to multiply with the present value factor to arrive at the present value cash flow after tax, which again we will reduce with the initial outlay to arrive at the NPV. So in our case, we have to consider only the incremental approach. So whatever is the differential one, that only we have to take. In case of upgradation, whatever upgradation cost, that is the incremental cost. But in case of replacement of new machinery, we have disposal of old machinery and tax payable on that sale of old machinery. That adjustment is there. So we have to consider 2,20,000, not 2,50,000. That will be the initial outflow. Then since the NPVs in case of upgradation is negative 1,91,000, and in case of new machinery is negative 2,72,000, in both cases it is negative. We should not check which is least, because the main point of going for an upgrade, going for a new machinery is the old machinery became old, and we have to check whether we can replace it or upgrade the machinery. But in both cases it is giving us a negative NPV, so it is not beneficial of either replacing or either upgrading. So we should continue with the existing machinery itself. We should not go for upgradation or new machinery. That's what they have also given. As the NPV in both alternative proposals is negative, the company should continue with existing old machinery. Thank you.